The most brilliant minds in modern finance once built what they believed was an invincible trading machine. It was staffed by Nobel Prize winners, backed by the world's largest banks, and entrusted with billions from the most sophisticated investors on the planet. And in just 6 weeks, it was gone. Not because it was a scam and not because its founders were frauds, but because they made one fatal assumption about how markets work. An assumption that has destroyed fortunes for decades, from Wall Street hedge funds in the 1990s to crypto giants in the 2020s. It's still quietly embedded in most institutional strategies today, and unless you understand why it fails, it'll eventually destroy yours too. Our story begins in 1994 when John Merriweather, the former head of bond trading at Salomon Brothers, assembled a team that seemed almost supernatural in its talent. He recruited Robert Merton and Myron Scholes, Nobel Prize winning economists whose option pricing models had transformed modern finance. David Mullins, the former vice chairman of the Federal Reserve, joined them, along with a roster of elite traders who had spent decades at the very top of their fields. Raising capital was effortless for them. Sovereign wealth funds from the Middle East, major Japanese banks, and some of the largest pension funds in North America and Europe, they all wanted in. Wall Street's biggest banks fell over themselves to lend to this new firm, offering extraordinary leverage on extraordinarily favorable terms. Lending to long-term capital management was considered safer than lending to many governments. Their strategy was elegant: search for tiny pricing discrepancies between related securities, spreads that were statistically almost certain to converge. When they did, LTCM would profit, and by using massive leverage, even the smallest move in their favor could produce huge returns. In the calm middle of the market, it actually worked beautifully. The returns were steady, the volatility was low, and investors were ecstatic. For a few years, it seemed like the perfect trading system until it wasn't. You see, the entire system was built on a Gaussian assumption. The idea that market returns form what's called a neat bell curve, with most moves clustered in the middle and extreme moves so rare that they can be ignored. In that world, a truly extreme market dislocation is a once-in-a-lifetime event, something that you can treat as an outlier, so unlikely that you never really have to plan for it. The problem is, the real market is nothing like this. Real markets are fat-tailed. The giant sudden moves that Gaussian theory treats as virtually impossible happen far more often than the models suggest. If the bell curve says something about what should happen once in a million years, markets will often deliver it every 5 or 10. In the real world, the tails aren't empty, they're actually quite thick and they're alive. And when markets move into those fat tails, they don't just bend the rules, they break them. Correlations spike to 1, liquidity disappears, and price action becomes disorderly and violent. In August 1998, Russia defaulted on its debt. Suddenly, LTCM's neat little spreads didn't converge, they actually exploded. Markets that were supposed to move independently all crashed together. The extreme conditions that Gaussian theory said would almost never happen had arrived right on schedule. And because LTCM had already committed nearly all its capital right there in the calm middle, they had nothing left to deploy when it mattered most. Their enormous leverage, over 25-1, magnified every tick against them into a disaster. In less than 5 weeks, the fund collapsed so quickly that the Fed had to organize a multi-billion-dollar rescue just to keep the failure from spreading through the global financial system. We saw the same structural weakness years later when Duquan's $40 billion Terra Luna ecosystem imploded in 2022. The entire project was built on the belief that its stablecoin peg could never be broken quickly enough to overwhelm the system. But when confidence cracked, the market moved instantly into the fat tails. The peg broke, Lunar supply hyperinflated, and within days the whole thing was gone. Different decades, different markets, different technologies. Same fatal assumption. Designing for the calm middle and ignoring the edges where the real danger and the real opportunity lives. And this is exactly what we have built with Minotaur trading systems. We don't try to predict what will happen next. We design for the moments when markets are moving the furthest and the fastest. Moments that Gaussian models treat as unthinkable, but that history shows arrive with clockwork regularity. We have developed proprietary algorithms and fully automated execution systems that react in real time to this volatility and market stress. Our capital deployment logic is built around one structural reference point. It's the power law support, the most statistically extreme support level for Bitcoin over its entire history, measured on a log-log scale. We don't treat it as an invincible floor. We expect it can be breached, which is why we keep our exposure light in the middle and hold most of our strength back for those moments of statistical extremity. And here's the key. This is not a mean reversion system. We don't enter early hoping for a bounce back to the average. We enter only when prices reach these extreme zones, and even then we're scaling cautiously in layers, assuming conditions can and will get worse. That's what allows us to turn market stress into an advantage rather than a threat. And this brings us to one of the most important distinctions in system design: concave versus convex risk structures. A concave system is strong in the middle but weak at the edges. It commits its resources in calm conditions, so when the stress hits, it's already exposed. Every move against it makes it weaker, narrowing its options until the only one left is liquidation. LTCM was concave, Terra Luna was concave. A convex system is the inverse of that. It stays small in the middle and grows stronger in volatility. It holds capital back for the extremes, and when they arrive, it deploys intentionally. Each new layer improves the weighted average price of the position, making profitable exits much more likely. And because our system uses dynamic trailing exits, even partial recoveries can trigger staged exits, locking in gains without needing the market to return to any theoretical mean. From here, our philosophy rests on 4 pillars. First, assume the extremes are actually normal. They are not black swans, they are part of the landscape. Second, preserve capital during calm conditions so you have strength when the market moves into the fat tails. Third, anchor only to statistically robust levels, never arbitrary lines or moving averages. And fourth, exit dynamically to capture recovery without relying on full reversion. Even Eugene Farmer, the father of the efficient market hypothesis, acknowledged that extreme events happen far more often than Gaussian theory suggests. They're not statistical noise, they're actual structural reality. An anti-fragile system accepts this. It maps the edges, it waits, and when they come, it acts slowly, methodically, and with the strength it has been holding back for exactly that moment. The Gaussian world is a comforting illusion. The real world is fat-tailed. They lived in the safe middle. We prepare for the dangerous edges. They optimize for the calm, we build for the storm. They bet everything on being right, we design to survive being wrong. That is the difference. That is the edge. That is how anti-fragile systems are built. And here's the truth. Those fat-tail moments, they're coming again. When they arrive, most strategies will break just as they always have. The only question is whether you'll be one of them, or whether you'll have a system that was built for that exact moment. That's why I'm inviting you to book a call with us today. We'll walk you through how our algorithms and automated systems are engineered to survive and thrive when the market moves into these extremes. We work with a limited number of clients at a time, and the next tail event will not wait for you to be ready. Book your call now, and let's make sure that you are.